you know who I am. And we've got a great panel here on corporate climate claims and the kind of tricky business of how companies are navigating the challenges of integrating carbon removals into the sustainability plans, targets, and so on. So again, I've got an excellent lineup on my panel here. I'm going to try and do this in order this time. So Sebastien Dewarrat, who is co-founder of Carbonx, a kind of carbon, I don't know how you best describe you, carbon credit broker, or I was trying to... Procurement, sure. Yeah. Okay, sure. There we go. To get the guy who knows. David Frank, Director of Sustainability Policy Engagement at Microsoft. Thank you for coming here. Leila, Toplic, Chief Communications and Trust Officer at Carbonfuture, a provider of carbon credits. Is that...
And MRV.
And MRV, oh yes, of course. Kemp, Head of Tech Carbon Dioxide Removals at NextGen CDR Facility, which is this like joint venture between Mitsubishi and South Pole. And Salah, who's Head of Sustainability at the payments company Klarna. So I think what would be really great with this panel is just to really understand what you guys are seeing in the market, what your experience is of like trying to build carbon removals into your sustainability plans, and to explain a bit of that. I think, Salah, it would be great to start with you and to understand a bit more about Klarna's Climate Transformation Fund and what the genesis of that was, and what technologies you see being picked up most through that.
Great, yeah, happy to tell you more about it. So basically in 2019, we, for the first time, did a neutrality claim and thought it's just so ambitionless. It's so easy to just take a little bit of money and say, well, we're a climate neutral company, and it didn't feel right for us, so we had a lot of internal discussions on what else we could do, and started to talk with our management, but also experts. We came across this BCG WWF Blueprint for Corporate Climate Practice and Nature and thought, well, it's an interesting way to think about effective climate action, to tax ourselves, and to think about where could we create as a business the most impact. So we started with setting up a carbon tax that we just recently also increased, because I think it's also important to continuously adjust. And we decided to take the amount of money from our carbon tax and disperse it to the Climate Transformation Fund, which is a fund that not only focuses on CDR, but also on decarbonization efforts and climate advocacy. But a huge part of the fund goes into CDR. And with that, we were able to, engage with experts in the CDR space and beyond, have a little bit of a hands-off approach to say, well, if we would choose what to buy, we will optimize for costs. But if there is real experts from the field that could assess those solutions for us and with us, then we might opt in for impact. And that's pretty much what the Climate Transformation Fund is trying to do. It's supporting a diversified portfolio of solutions. I'm going to focus just on carbon removals, and support an array of solutions that really needs first buyer movement and really needs support in order to get started. So we're not talking about the Climeworks of the world and the Heirlooms. They were amongst the first organizations we supported back then, and it's great to see how great they've been able to scale. But for us, it's really more the role of being a capacity builder in this space and trying to show other companies that we need to support the space. There's no way around it if we look at IPCC. And there is a really high degree of innovation that needs support, and that goes beyond R&D. It really is about creating a purchase power and creating trust with other companies to be the second and third mover in that space. When it comes to the solutions, we are pretty much methodology agnostic. We try to support all the new innovations that are out there. Some of them we've heard from today, but the core aspect of it is really from a corporate perspective, and that's maybe something that is relevant to some corporate representatives here, is to not focus on a neutrality claim, and is to not try and say, we are a climate neutral company, it doesn't matter whether through reforestation projects or removals. It's all about acknowledging the fact that you as a company need to contribute to a world to get to net zero. So if we as Klarna would mitigate all our negative emissions or negative impacts beyond climate, then our impact on this world is so insignificant because we are on the low emitting end when it comes to corporate impacts. So we needed to ask ourselves, what could we do to support the wider industry and the wider world to get to net zero? And that's the approach that we chose to take, and it's a contribution approach that we see a lot more companies are looking into and supporting. And I think that's what I would expect from companies that are low emitters. When you look at the high emitting industries, please focus on decarbonization 100%. Picking up one thing from the previous panel, I do think it's really crucial to think about CDR targets separate to your net zero targets.
Mm-hmm. Yeah, super interesting. And just briefly, I mean, as you said, you look at lots of different technologies, but obviously you can't support every single thing. So exactly how do you choose which project?
We work within an advisory board, and our partner Milky Wire. It's an advisory board of scientists and lots of nonprofits, some registries as well. And what they do is they look at the long list of income. So it's an open call for proposals. Over the last 3 years, we supported 4 batches, around 30 to 40 projects. The last incoming was 150 solutions from like all across the world, and then they basically assess and vet those technologies on all different kind of levels. It's very transparently reported, so you can just look it up on our website or on the Milky Way website on how we assess them. And we also disclose the information about the projects that were not selected, because we still think there are so many that are worthwhile supporting, but maybe it's not us. But this is also one reason why we wanted to open up the Climate Transformation Fund and have other companies joining. So now we see Spotify being part of it, Avanza, Mentimeter, and other companies joining. And that's really what we need to do. I mean, with our carbon tax over the last 3 years, we've been only able to raise $7 million from our own carbon emissions. And that's a tax that is $200 for Scope 1, 2, and travel, and then $10 per ton for Scope 3 emissions. So those 7 million, they're nothing compared to what we're seeing in terms of volumes to the Microsofts of the world. So it really requires us to get other companies to tap into the same space and do this collaborative job with us.
Mm-hmm. Interesting. Sebastien, I mean, on this technology point, I know you guys talk a lot about being technology agnostic or technology neutral. I just wondered if you could tell us a bit more about your approach and why you think that is so important when we have so many, there's no great certainty about exactly which approach is going to work best or which technology will work best.
Right, absolutely. So, when we started, we made, I think, clear choice of saying we are technology agnostic, but we want to focus exclusively on permanent or durable carbon removal. So, and then the way we look at it at the moment, it's too early to pick winners. I think what's important is to focus on technology that have the capacity to at least get to probably gigaton scale, so 1 billion tons per year. But then, when you look at those different technology, I think most of them have probably a range of 1 to 5, gigaton. And saying today we should focus more on this one or on this one, I don't think is necessarily the right approach. I think different technologies have different strengths and weaknesses. If you look at the biomass, for example, of course, is the one that is today the most mature, also has the best track records. There is a bit more limitation when you think of scaling with the biomass sourcing. And I don't know if you compare it, for example, to enhanced weathering, where still a lot of question marks with regards to the quantification or the MRV of the carbon removal. But when you think of it from a scale perspective, it's mainly logistics, so easier to scale than other technologies. So on and on and on and on. So I think probably by the end of the decade, we'll be in a better position to say, okay, we need to support maybe a bit more, this pathway or these pathways. But as it stands today, I think we prefer to remain technology agnostics and also, let the time for the different pathways and projects and technology to demonstrate that they can scale.
Mm-hmm.
Yeah.
And David, I mean, Microsoft, we're sitting in the Microsoft office. You guys do a lot of work on this, and we heard from other David in the previous panel about what you're doing with Ørsted. I mean, when you're in a position where you have plenty of capital to deploy into carbon removal and different technologies, how do you choose where to deploy that?
It's a great question. And so I sit in the policy team, but we work really closely with our carbon removals team. And I think they view projects as a sort of cohesive set of activities. And we're very public about this, about how we sort of consider projects that we will invest in and partner with and about that are relevant to generating those CDR credits. So we evaluate a carbon removal project on a set of sort of purchasing North Stars or criteria. And so we think about that as sort of additionality, importance of durability, measurability, environmental justice is also a key part of that. And then making sort of, in effect, that's about making sure projects do no harm. and then we sort of measure those or judge the credibility against a sort of set of criteria, and we're sort of very public about that. And then we're sort of agnostic on what those projects might be, and you'll have seen, and people in this room may have partnered with us or have seen some of our announcements, and we sort of take a balanced approach then. So yes, Ørsted, Stockholm Exergy, I think was announced last week. We've recent announcement again with a partnership with regards to reforestation in the Brazilian rainforest. And so we sort of take that approach, and then that leads into a sort of range of sort of investments and partnerships to date.
Mm-hmm. And then how do you go about, tell us a bit about the actual process of building that into your own sustainability plans and your own net zero goals, and how you do that sort of quantifying part of the process?
Sure. So equally good question. So I think if we take a step back, as a business, we made in 2020, I think some of our senior leadership were in this room when that announcement was made, as well as in Redmond. We made sort of some very ambitious commitments about our sort of forward look and what we wanted to achieve. And what that has led to is every leader in the business looking to reduce the carbon emissions within their own sort of business stream to date. Mm-hmm. And then CDR, or carbon removal, is that sort of activity to then do that final sort of harder to reach bit, because we won't achieve our targets if we don't then sort of invest in the CDR solution.
Mm-hmm, mm-hmm. Yeah, I see what you mean. And Megan, I wonder if you could tell us a bit, about someone who's working at a facility, how this, what you can tell us about the trends in buying and what people are looking for, what corporates are looking for at the moment.
Yeah, absolutely. So we just quickly, NextGen's an advanced buyers facility. So what that means is we have a portfolio of removals that are under $200 a ton, are certified, and are delivering between 2025 and 2030. And we do that on behalf of a set of buyers. So right now, our founding buyers like UBS, BCG, big organizations like that are very publicly buying removals internally and externally, like by themselves. So we go out, we talk to buyers all the time, and I think there's three big reasons why people are buying. People like Microsoft, like Klarna, they have social responsibility. This is about building sustainable brands. This is around like really driving impact. And often it's companies that have really low emissions, to your point, for their profit margins. And then you've got people who are trying to control risk. So one of our buyers is MOL Shipping. They know regulation is coming. They know that they are going to have a huge amount of residual emissions. And they then need to act now, learn the market. And then people who see big business opportunities. So where they can get in through advisory, this is going to be a big line for them, BCG, where they can get into commodities trading. This is where oil and gas are getting into the market a lot, as well as in supply. But I think it's important to note that there's basically 200 buyers right now, and the next pool of 70 buyers are being talked to by absolutely everyone, and probably everyone on this panel has chatted to them at a certain moment. But the projection is that in 2030, demand is going to outstrip supply, and there's many reasons for this. But I think we should watch how the market develops based on, like, does trust improve? I think there's a huge lack of trust in the market right now, especially with low integrity credits that is really getting matched up with carbon removals. I think price has to come down, and right now we're seeing price go up, often because of inflationary concerns, because of teams that they don't know how to scale this market. They don't know how to build a huge infrastructure project. And so they haven't baked in the right prices. And then that you are actually able to see a signal from government or even a voluntary organization, SBTi, whoever, can you actually claim based on these removals? Do you know you're going to be able to claim on a compliance market? So the dynamic will change, but it remains to be seen how quickly.
Yeah, super complex market.
Yeah.
Leila, I just wondered if are those similar drivers to what you're seeing? Does that reflect your experience in the sector? And also tell us a bit about some of that, navigating that complexity.
Yeah, absolutely. And let me just pick up on a couple of points that were mentioned both on this panel and earlier. So as just a way of introduction, at Carbonfuture, we've built market infrastructure, what we call digital trust infrastructure, that supports the entire life cycle of durable or industrial carbon removal. So really with a focus on building trust in every single step, from the initial supplier support services, which could be really onboarding to certification or MRV, to due diligence both of the supplier projects and their operations, to rigorous tracking, or what is typically called MRV, and that adheres to established third-party standards like PURA, and also includes third-party verification, third-party certification, all the way to then providing these portfolios of verified high-quality credits to companies like Microsoft. And one of the key topics that has been also mentioned in this discussion is this question of trust. So companies need to be able to trust that what they're purchasing is of the highest quality and reliability in order to protect their reputations, to protect their financial investment, and to really ensure that they are indeed having the impact they intend to have. While some of the earlier market leaders and market builders might have invested in actually building in-house expertise to navigate the complexities of the market, the next wave of buyers needs the market infrastructure that provides that transparency on the credit quality. And that's where the standards together with DMRV come in. As noted earlier, MRV is critical prerequisite for scaling CDR. So let me just take a moment to connect a few dots in terms of how does it actually work. Standards define what is quality, what data, what documentation is needed to assess quality of a carbon removal project. Digital monitoring, reporting, verification system, and I would emphasize independent monitoring, reporting, verification system will then go and actually collect all that data, all that documentation, chain of custody information. So that could include carbon content, production volume, storage application, and so on. And if these are digital systems, which is what Carbonfuture operates, it would also collect the data from various sources, and it could be near real time through IoT or ERP integration or manual from the suppliers. It would also flag anomalies so that suppliers could actually optimize their projects. Now, that data is then provided to third-party verifiers. These are accredited, standard accredited validation verification bodies that review that data, issue a report, send it to standard reviews the report, and if everything really aligns with the guidelines, credit is issued and listed on the registry, and it can be then used to balance emissions. So the role of MRV is to provide that transparency and really manage the data that is required in order to assess the quality of the carbon removal credit. And it does play an integral role in making sure that we can scale this market and make it truly not only meet our climate goals and also make it a true market, which I think McKinsey estimates as a $1.2 trillion market.
Yeah, it's going to be huge, absolutely. Just on this point about data is so interesting because it sort of crops up actually in quite a lot of different places, but ensuring that quality of data and how you get that. I mean, from your point of view, do you have issues there? Are there sort of nitty-gritty elements where that is actually just difficult to understand and you have to change how you do things or change a project that you're looking at? Or?
Yeah, it's a great question. This is one of the just transformations that we hope to see in the market is moving more towards digital and moving more towards automation and leveraging IoT at the production facility level, for example, integration to the ERP system via API, rather than having the manual data ingestion. So that is important both for efficiency, and efficiency also in terms of credit issuance, as you're getting data almost real time, but also accuracy. So digital is absolutely critical.
Yeah. David, just tell us, how much have you beefed up your department in this respect? So I'm thinking, this is incredibly complex. And how many people do you need in order to manage all the different elements that are involved in buying, selling carbon credits, ensuring the projects, so on?
It's a great question. So obviously we're one of the world's biggest buyers in the CDR space. And the carbon removal team, I can't remember the exact numbers, but there's a sort of, we've built a core team within Microsoft that has that sort of real expertise. But then, as we've heard on a number of previous panels, that point about partnership and collaboration is equally key. So they will also work with, I'm sure, a number of people in this room and beyond, to sort of help build that knowledge base and expertise. And so that when they are out talking with potential partners, they sort of can sort of drive sort of really those conversations in depth.
Salah, with your, are you going to?
Yeah, maybe just two things to add on why companies are doing it. I think a fourth reason also, just to add on your previous points, is it's a really smart investment already for companies to already try and understand what is it that I will need to do in the future, what will the market look like, to engage with those companies, understand what solutions are there, and really get into the lingo and the quality understanding of this new space, especially when you are in ESG. It's something that you will have to do. And if you start early on, that will just be a competitive advantage for you as a business. So let's say you have a 2040 or 2050 target, it's going to come your way at some point. I do think that it's smart to already have the relationships and understand that. And that's something that we definitely also talk a lot about internally, and is another reason why we're so firm on staying true to being in this part of the industry. The other aspect on trust is, I feel that yes, we need a lot more trust, and we need all those systems and the data, and we need to make sure that what we're buying is actually really good. But we also know that there's way too few buyers. So if you're not buying right now in CDR, you're probably buying in reforestation and nature-based credits. So one thing that we discussed a couple of years back with some of the organizations is to say, well, if you cannot deliver those credits, can you provide me with alternative nature-based credits? It's not something that I'm highly encouraging, but there is a way to mitigate this risk, and there is a way to have those conversations as a business with those project developers that kind of mitigates the risk, but also builds the trust over time. Because what those early stage companies need is trust from corporate buyers. So I do think that it's really also important to not just try and create the perfect system for this industry, but rather have a default to action if you're really true with your commitment to real effective climate action. It's not just waiting for everything to be ready and perfect. That never worked in corporate sustainability, and that goes beyond CDR. I do think that companies need to early on adapt new trends and drive innovation and be part of the innovation right from the start, and then in partnership, develop the market and the system that we need.
Yeah, if I may add to that, I think that's a super important point. Just some of the numbers that I think are helpful to share. Just if you have a net zero commitment, you're making a commitment to CDR. So according to SBTI, there are over 3,200 companies that have net zero commitments. We, in the CDR industry, we celebrated the kind of 2022 to 2023 increase in the number of buyers. It was only 188. Out of that, only 14 purchased over 10,000 tons. So exactly the call to action. If you have net zero targets, you should be thinking about CDR today, learning your way into the market, and also at the same time being a market catalyst, because we will need to catalyze all of this supply. The second thing that I think is important to mention is in addition to spot purchases, which could be just you trying it out and making a business case to your management, it is important to have multi-year agreements, because these multi-year agreements provide a supply to various carbon removal projects and allow you to reach your net zero goals, but also they're market catalysts. They help build the market. They send the signal to the supplier that they will have the financial support they need in order to build up the supply.
And can I just jump in quickly? I think I agree massively with both of you, but I think if I'm an organization that's not Klarna and it's not Microsoft, I'm really worried about risk. Like, I'm so worried about getting involved now, putting my head above the parapet versus waiting, coming in later. And I think what we need to do, and what some of us do is think about, like, how do you control that risk? And there's lots of ways to do it, but one way is, and you were kind of getting it, like a portfolio approach, thinking about, like, fungible to the extent possible, credits that you can exchange if reduces delivery risk, put it globally. Let's not just look at the US, let's not just look at the EU. And that will also help reduce risk when it comes to regulation and what's coming around the corner. So I think being in the mind of someone who isn't thinking about carbon removals all the time and is really worried about their bottom line and their public risk, think about that portfolio approach. And whether you do that through something like direct asset management approach, whether you do it through something like a buyer's club like NextGen, it almost doesn't matter, but just access the market in different ways.
Yeah, great. You actually preempted my next question to Sebastien, which was how do you drive more buyers into the market? Or what, from where you sit, how would you?
Yeah, I would say most of our clients think of CDR. They don't need to be net zero today, so it doesn't make sense to try to buy CDR to be net zero this year. They all have commitments usually between 2030 to 2050. So most of them look at how can I build an inventory over time. And so most companies have a pretty good idea of how much they can decarbonize over time. And for that, you can then pretty much calculate how much CDR you will need over the next 20, 25, 30 years. And then the problem is it's a market where there's zero liquidity. So if you're a buyer, you say, I want to buy carbon removal, it doesn't exist. So you have to look into the futures. And I would say a lot of contracts are being booked out pretty quickly. So I think a lot of companies are also coming at it with a strategic approach. And I think that speaks to one of the arguments to why they need to engage early. First of all, for their own emissions, but a lot of companies are also thinking of that for their suppliers or for other strategic reasons. And the other thing which is great with CDR, I think especially if you focus on the permanent CDR, is once you actually receive the credits, you can book it as an intangible asset on your balance sheet. So whether you want to use it this year or in 5 years or in 10 years, if it's permanent with very low risk of reversal, and I think that's why at Carbonx we focus exclusively on those pathways that give that certainty. You can make a case, I think, internally on why this is strategic and on why you need to engage early. And and it's a message we try to indeed push into the market, because I think some company might look at it. I think, Leila, you had the terms before at lunch that I think is a really nice one. It's instead of saying it's voluntary market, it's saying it's pre-compliance. Which I think, is a nice framework to say, a lot of companies will have carbon liability to manage. So don't wait, until regulation is there to engage.
Yeah, did you want to?
Yeah, if I may add, I think pre-compliance fits it really well, because when you look into the majority of ESG-related frameworks that are related mainly to disclosure, there's nothing that you do on top as a business that is going to be incentivized. So if you're early in the CDR market, or if you do a great initiative in philanthropic work, that's nothing that you will be able to include in your reporting. Nevertheless, we see tons of companies doing a lot of stuff that goes beyond compliance. So I do think that there is this opportunity, and it might be a competitive advantage or a brand building exercise. But no matter what the motivation for that is, there is this huge opportunity for businesses to think about how they could leverage their clout in growing something like CDR or another aspect in ESG. And for us, for instance, in CDR, it was quite interesting to experiment. Is this something that our consumers could be interested in? We serve 150 million consumers across the globe. For the majority of sustainability managers, it's hard to grasp the complexity of CDR. But we try to see, as a lot of consumers were open to do those neutrality and carbon neutral deliveries or flights and so on, that's something we shouldn't be doing anymore. I do think that there was something there that we wanted to find out around, do consumers want to make a contribution if they understand what it actually is? So we tried this educational effort to help consumers understand, who are these companies, what do they do, and what does carbon storage mean, and permanent storage. And it was quite interesting to see that a significant amount of consumers actually engaged and contributed to the Transformation Fund. And with that, we could allocate funding beyond what we give through our business operations. So I do think we just all need to be a little bit more innovative in the way we think about corporate action in ESG, and that goes beyond just CDR.
David, do you have similar initiatives in that sense? And do you kind of do education also in your supply chain for smaller suppliers so that they understand what you guys do already?
Sure. Taking a step back to Megan, your point about if you're already in this space, then you've sort of turned up at events or listened and talked to the right people. I think we also recognise the responsibility we have as a huge sort of player in this market to share our learnings. And we've done that, I think, for the last 2 years now, where our carbon removal team have published a report setting out the lessons and learnings, and that's on our website. And so people who are only now thinking about how does carbon removal form a part of their activities, they can look at what we've done and draw from that what's relevant for them. And similarly, we reference it in our annual sustainability report and the progress we're making, and are quite open about the challenges we face in a sort of business of the nature of ours. I think if you look at our supply chain, absolutely, we have sort of an ongoing conversation. This is broader than just the CDR side, but in terms of carbon removal and reducing carbon emissions, we recognise challenges in a number of parts of the world in doing that, because there's sort of energy generation challenges, there's sort of getting clean energy to our suppliers because they're local grid challenges or congestion. So we're sort of very active in those wider policy conversations as well, and sort of listen to what our supply chain has to tell us, because obviously that's where we get that signal from and learn from.
Megan, I wanted to come back to this point you made about the price going up rather than down. I think this is really interesting in terms of what impact has that got on people coming into the market, and is it what am I trying to say, like a hurdle?
Definitely. I mean, everyone draws a graph that says price is here right now. Let's do DAX, like price is 650 to 800, and by the time 2030, great, it's going to be 250, and then by 2035, it's going to be 100. And I think we would love to believe that, because 100 fits in, right? It fits in with carbon taxes internally. It fits in with internal carbon prices. You can make that work, especially if you have made a very good case internally to switch from low integrity, short-term carbon credits or carbon offsets. But you've had huge increase in inflation, especially after the Ukraine invasion. You've had companies that started with a really interesting set of scientific founders actually then not be able to translate that into big infrastructure growth. I mean, you've only got, 1-2 DAC plants online now. I think we're going to see a lot of those organizations realize as they try and reach scale that it's really, really hard, and it takes so much funding. And the amount of capital that is flowing into the market to support this like project finance, so beyond VCs, is not coming really. And it's partly not coming because you need long-term offsets that create bankable projects, and that is slowing down as companies are more risk averse, as companies don't have the cash for it. But you basically have seen all of these things compound so that the prices are increasing and they are stopping people entering. I think this will change, but if supply gets constrained the way that we're assuming it will by 2030, market dynamics suggests that price is not going to drop with costs. So I think that is going to be prohibitive over a long time period, and that is really where regulators come in. It's really where inclusion in ETS and set prices come in, and it's where organizations that are able to like share and collaborate and partner rather than like shut off and keep their costs very private and therefore have a very intransparent kind of supply controlled market comes in.
Yeah, great. Leila, where do you see the role of regulators in this? I mean, how can they ease that issue? And also, something I want to ask you about was how great is the financial risk to companies if they don't get it right?
Yeah, I mean, just to echo what was already said on the earlier panel is that companies need predictability in order to invest in carbon removal, and that is key. That is really the role that policy needs to play, and play quite urgently in order for us to also be able to reach our climate goals, to have the supply that is required for that. And again, coming back to numbers, today, like IPCC says that we're going to need up to 10 gigatons by 2050 per year, to remove per year. Today, we're removing around 2 gigatons. Out of that, durable carbon removal is 0.001%. What this means is we need to grow this market by 5,000 times. Policy has a key role to play in ensuring there is predictability and clarity for the companies, but also for the investors that can support the ecosystem in scaling up the industry. So that is the role of policy. The other one that I would like to mention is the procurement. So government procurement, we need to see more of that. We're seeing some of the examples that needs to be at a larger scale. And for those with deep tech investments, support for investment in CapEx.
But of course, I suppose that comes back to this learning piece and, understanding of exactly what is being invested in amongst both policymakers and in investment circles. I mean, Sebastien, are you seeing enough understanding, do you think, about the different options and from where you sit?
I would say no. And I think to Leila's point, regulator can really engage directly themselves, but they can also support. And I think the two key stakeholders to a project one is the buyer and the investor. And I think both of those stakeholders at the moment are not there yet. And so a lot of things can be, and they need to work in collaboration, because for a project to be, could be kickstarted, you need those offtakes, and they need to be bankable. And the financing will review that. And if it doesn't, match their requirements, even if you're selling CDR, it doesn't really move the needle for you in a way. And so I think if regulators can find ways to help the bankability on the buy side, because buyers, it is a big risk, as you mentioned. I mean, you would need to commit long-term in advance and guaranteeing that you're going to buy the tons. So supporting buyers to make those contracts bankable and supporting the investors, reducing the risk when they engage, because that's another problem I think you see in CDR is that most of the funding has come either from government or from VCs. And I think VCs are really important to de-risk the technology, build the IP, but CDR in essence is a very much infrastructure and logistics industry. And so I think that's just the first step, but as soon as you're starting to scale, VC is not the right form of capital. And I think the level of sophistication today for that next wave of investors is not enough there, especially in terms of the contracts. And I think there is a role of also policy in standardizing that, making it easier for both investors and buyers to come in.
Yeah, it feels like a huge education piece there. I also wanted to touch, we have sort of, you've mentioned this particularly, the sort of move towards contribution claims rather than compensation, a bit around that dynamic and how the market is moving. You've sort of spoken to it from the Klarna point of view, but from other people you're collaborating with, do you see more of a move in that direction?
I don't think it's many, but from what I see through the conversations with other companies, it's a lot more companies that are interested in the contribution approach. A lot of companies that we work with, and we work with 500,000 retail partners, and the majority are being in the fashion industry. So it's kind of interesting to see what pickup we may see in that space. We also see that there's a lot more papers and research and standards around contribution logic. So I do think that it's something that is going to pick up. The question for me often is, what's the motivation behind that for the companies? Is it just being able to replace, a previous approach that it was more related to offsetting and being able still to make a claim? Or is it the company realizing that this needs to be about quality? And I think that's the core difference when we talk about contribution. It's about companies realizing that their support needs to go into qualitative solutions, things they fully understand, and not initiatives where they just open the wallet and say, this is the bit that we've done, and then we're out of it. And that could take a lot of different forms, right? It's not just buying from CDR companies. It could be being a capacity builder in that industry, supporting nonprofits in the advocacy space in that industry, or looking into procurement solutions in that industry. So I do think that there isn't just this one solution for companies on how to contribute, and it's not just buying, which is why with the transformation fund, we're really trying to see what else, what other projects can we support in the nonprofit space and in the decarbonization space that also need to grow as the CDR industry is growing.
Mm-hmm. Yeah, David, do you have how do you sort of balance sort of I don't want to make it too much of a dichotomy here, but compensation, contribution.
It's a great question. And when we made our commitments back in 2020, I think talking to colleagues who were working in this space then, I think it's fair to say contribution commitments weren't as popular So we're very much on the compensation. We sort of what we started then and continue to do is much more on the compensation side. So it's about how would we continue to sort of in every bit of our business reduce sort of carbon emissions and then use CDR for that sort of to compensate for that bit that's hard to do between now and 2030. And then obviously the other part of our commitment was to by 2050 remove from the atmosphere all the carbon we've been responsible for since our business started in the mid-1970s. So that's how we're viewing it. If just sort of take a step back a moment, Dave, to your sort of previous question and some of the comments around role of regulation. Absolutely, I think regulation and the sort of role policymakers can make in that conversation is key to sort of trust and building sort of wider confidence. I think some of that's ongoing. Obviously, some of it's already happened. So the European Union's own Corporate Sustainability Reporting Directive, the obligations under that on the businesses that are in scope. I think the EU's assessment is sort of 55,000 and probably 20-odd thousand in the first round who will be in scope. Some things they have to report on, like carbon removal is going to factor into how they then report going forward because sort of their emissions data to point will be that disclosure, and then they'll have to, one of the questions back may well be like, what's the trend? What are you doing then over time to deliver? To your point about the sort of commitments companies have made publicly.
Yeah. And how difficult is it when you're going to have different reporting systems in different parts of the world? We see the US doing something slightly different. We see the EU doing something slightly different. I mean, Microsoft is incredibly global, so...
We are, and we recognise that sort of privilege that we have, like given this type of business we are and the scale we have. But I think one of the things, and we've said that in our public, the filed comments, in a number of markets, so UK, Australia, Singapore, Malaysia in the last 6 to 12 months, is that we sort of talk about the importance of digital filing, so to sort of make it easier for companies in scope to file. That also makes it obviously easier for the bodies receiving those returns to sort of do the analysis and publish the sort of next, sort of the output and the next stage of that sort of conversation with society. I think one of the other points we make is the importance of interoperability, so that if you're in scope of the EU CSRD and you've built a work program as we are to be compliant, you can take that return because it maps to sort of agreed international standards, and then say the authorities in Singapore are developing their own regime and it maps to the same standards. We can show what we filed in the EU to be compliant, and that makes us compliant there. And that's, I think, going to be key because obviously that then makes it easier for people to be compliant, and all businesses want to comply with the laws of the environments in which they operate or countries in which they operate. And that also helps build confidence in sort of others to sort of do the same thing, and then in wider society where trust, as we all know, trust in business is low, but is incredibly important.
Can I add something just to connect it to the earlier conversation, this point around compliance? Compliance requires transparency about what exactly underlies the claims. And this is where systems, for example, like MRV with carbon removal can actually provide that information that is needed to basically say carbon removal has actually occurred. So coming back to, we have various components already in place to make this possible for all types of stakeholders. So whether it's different market access points like the buyer clubs, or it is the infrastructure like standards and DMRV to support the companies in acting on their net zero targets and communicating and complying with the upcoming regulations.
Yeah, I mean, absolutely. I mean, I think as a business, we're absolutely focused on that sort of that verification point, that sort of 100% focused on that, where we've got a ton of carbon credit, like absolutely maps against a ton of carbon removed from the atmosphere.
Yeah, and that's challenging in itself.
Yeah, I do want to add that I think that the amount of registries and frameworks is obviously really confusing and hard to follow up with as for companies. And I don't think we have that convergence, and I don't think that those registries and standards really talk to one another. And that is something that would make our lives in corporates much easier. And the reality is the same when it comes to the regulations. It's really not helpful to have 20 different regimes across countries to report on ESG matters. And I'm saying that because ultimately, we do report in order to show progress and to show what else, what we're doing, how we're responsible businesses. And that reflects often on our customers and relationships we have as businesses. If you want to transfer this to products that consumers would buy, we've seen a huge amount of certifications around sustainable products or products that claim to be more sustainable, because of their water usage, because of their land use, their CO2. And that's where we never saw convergence across regimes that would say what makes a product actually more sustainable. And that's also why we have regulations like green claims that don't necessarily stem from this is a company that claims to be climate neutral. No, it's more about, is this a company that is trying to mislead a consumer? And that's why I think this conversation is so important to also give back to regulators that we need convergence across those frameworks, because it's not only important for the claims that a company wants to make about themselves and their corporate climate action or ESG efforts, it's exactly as important as what the company wants to say towards its consumers. So my key message is we need convergence across all those regimes.
And until we get that in regulation, I couldn't agree more. We need someone like the ICVCM and the core carbon principles to play that role. And I think that's what, I know it's coming, and it's coming at speed, and they're doing it as fast as they can, but we're not going to get to regulation like the CRCF is going to take time. We haven't even agreed which methodologies they're going to focus on 100% yet. We need that middle bit. And so it's also a plea to the voluntary carbon market to provide that certainty and to stop the fragmentation.
Yeah, and I actually wanted on the voluntary carbon market, what needs to happen there in exactly that in order for that to happen?
Yeah, that massively, everything Leila's been saying around transparency and measurement, and having data in a clear, open way on the blockchain, 5 people have said to me today, that's going to hugely help, right? And with compliance signals and with we can't say trust enough, and I think trust has come up everywhere. We have a market that could be exemplary in the voluntary market, then shift to the compliance market, that it stays trusted. But we've seen what happens with lower integrity credits, and I feel like I'm in quite a good position to say, it has a huge impact on businesses, on individuals, on companies' trust, on the level of the market, people engage with the market. So we just have to maintain that trust as much as we can.
Having seen that we're running over, and trust being probably a good place also to end, thank you so much. It's been really, really interesting listening to all your insights. Thank you all for being here, and I hope you learned as much as I did.
Yeah.